Do you want the AI notes, Elaine?
No,
Okay. Um,
it just says type read stop. I think.
you might need to do that too. I typed it.
I don't know. It didn't tell us it stopped it.
Okay, folks. It is 11:30 according to AT&T. So welcome. My name is Jim Noble. I'm the CFO of Mid-Texas, and invited folks to this. I'm going to keep an eye on. In fact, I'm still getting requests at the very last minute for links, so I'll be watching that. I do want to just briefly introduce Sandra Fowler. Sandra works for Sommerville and Associates in Arlington. They are experts that I have reached out to numerous times on clergy taxes and church finances. And Sandra works for Elaine Somerville, who wrote this book, among others, which I am slowly working my way through. They do presentations. I was first introduced, they did a presentation for TMF that I attended and was impressed. And so this is a complicated area, and Sandra's probably not going to hit every little thing. If you have questions, please type them in the chat. I will try to keep track of those. I don't know that we'll be able to get to them during this seminar, but if we can, we will. And if not, I will take a record of them and try to reach out to you. Or you can, of course, email me. Okay. And I can try and get answers for your situations. Also, don't forget, there's another one of these, a little bit more focused on church, kind of end of year tasks for churches around taxes and payroll and that kind of thing. November 17th at this same time, 11:30 Central. November 17th, about a month from now. So, all right, without any further ado, Sandra, take it away.
Perfect. I'm glad y'all are here. I do want to kind of echo what Jim was saying. I've been working with Elaine for 23 years, I think. So I started here actually as an intern when I was getting my undergrad degree. So I've been here working with Elaine for a really long time, and this is kind of what I do and what we do. We do a lot of consulting for churches and ministers. So this is kind of our wheelhouse. To that end, I've done this presentation several times also. I like for it to be helpful to you where you're at in your situation. So if you have questions, please type them in the chat. I try to kind of catch them if I see them while I'm presenting and answer questions kind of at that end. Some of these topics we don't really come back to, so it's a little bit easier to ask questions kind of as we go, as opposed to trying to group them all together at the end and then kind of have to recircle to the things we've already discussed. So if you have questions as we go, please type them in the chat. I'm going to try to pay attention to that while I'm covering the material and kind of, I'm probably not as good at this as Elaine is because she's been doing this longer than me, but try to catch those as we go. I will tell you, I'm also, in addition to being a CPA and working for Elaine, I also volunteer and do the accounting at my church. So I kind of have both sides of that. I have the professional side, I know what the requirements are, but I do have a lot of hands-on experience with the ministers and the church side from the volunteer side as well. So I think that helps me to be able to kind of see where you're at, catch you where you're at, and answer your questions in a way that not only is what the IRS requires, but also is very kind of a practical approach to some of this. All right, so today we're going to talk about minister's tax. I will tell you, I'm amazed how long I've been doing this, and we still run into people who have just never been informed about how ministers are different tax-wise. You would think eventually you kind of ran the gamut and everybody was informed and everybody has all the information, and yet I still find people who just don't know. And it's kind of like you don't know what you don't know until you're in that place and you do get informed, and then you're like, whoa, I've been doing this wrong forever. So this is a very basic, starting at the basics for all the things that have to do with ministers' taxes. Hopefully all of you here know that ministers' taxes get to be a little weird. And I think it's kind of humorous in some ways that we have these people who are great at their job and very visionary and very passionate, and they're good at what they do, but are not generally administratively minded. And then they have this very complicated tax situation that they have to wade through. So they need some help, and they need our help, the people who are helping the church do the accounting, that side, to be able to wade through some of this, because it really just does not make sense to them, and it's just not what their strength is, right? So we're in the place, we've been put in a position where we can help them once we have an understanding kind of what should be going on. So I've done this session a couple different ways. I've done it directly to the minister, which is kind of a little bit of how this goes, this one comes through. But there's enough information in here. If you're administering the payroll or administering from the church side, you can help your ministers. It doesn't make it not applicable to you just because this is kind of a little bit addressed to the minister. Okay, so first thing we need to do, before we can get into kind of the details and the nuts and bolts of this, is we need to define who a minister is. Now, this first primary definition that we're going to talk about, let me get my, is it going forward for y'all?
No, just the who am I. There it is. There it
Here
is.
we go. Okay, so first we need to define who a minister is. Now I will tell you this definition here is twofold. This is an IRS definition. We're going to talk a little bit in a second about the Department of Labor definition, but this is the IRS definition here as to who a minister is, and that is twofold. So number one, they have to be commissioned, licensed, or ordained by a church. That's non-negotiable. You can have people doing minister things all day long, but if they are not commissioned, licensed, or ordained by a church, they do not qualify for this minister treatment, okay? So obviously in your denomination, you may call it something different, but kind of the idea is that the denomination has recognized you in some way as a minister, and just calling you that is not sufficient. There's usually some process. There's usually some education piece that goes in here, maybe a ceremony of sorts, something like that. So they have to be commissioned, licensed, or ordained by a church. That's the first thing. The second thing is they have to be doing minister things. So obviously, across multiple denominations, that's going to be a different thing. But the IRS has kind of defined that a little bit for us to give us some guidance. So those minister duties include the performance of sacerdotal functions, so communion, weddings, burials, baptisms. They also include conducting a religious worship service. So this is usually your pastors. Also could include your worship leaders in there because they are kind of involved in this conduct of this service. Controlling, conducting, or maintenance of a religious organization. So this could be your even your administrative pastor within a church setting. I will tell you that definition there is very specific to churches. So if you have a religious non-church organization, the IRS doesn't really define the maintenance of that religious organization to be a minister duty, but within a church it does, okay? Teaching at theological seminaries or on assignment by a church. So this minister can be doing virtually anything as long as the church assigned them to do it. A lot of times this one applies to like somebody who's within your church who's assigned to like a sister organization, like to help at the food pantry or to help at the homeless shelter. That's usually what this here, this assignment by a church is referring to. So in order to be treated as a minister, you have to have both of these. You have to be licensed, commissioned, or ordained by a church, and you have to be doing minister duties for IRS tax purposes. I just keep deciding not to advance on me. That's really annoying. Okay. So once you've met these two steps, so you're licensed, ordained, commissioned, and you're doing those minister duties, you have to be treated as a minister. It is not optional. They don't get to pick. They don't get to choose. You have to be treated that way. And people don't always like that because, as we're going to find out here in a second, that often means your taxes are a little bit higher and you have a little bit of a detriment on that side. So once you've met these steps, you have to be treated as a minister for IRS tax purposes. So what does that mean? So ministers are considered to have dual tax status. That means for two different taxes, they're treated differently. And this is what gets a little confusing. If you've never dealt with this before, it kind of blows your mind because it doesn't really make sense. Yet this is the way that the IRS has chosen that ministers need to be treated. So the main two tax questions that we're looking at is, how are they classified for federal income tax purposes? And how are they classified for Social Security tax purposes? And that's different. That's what makes this a little more complicated than just a normal non-minister employee. So let's talk about federal income tax and how they're classified for that first. There are two possible ways a minister can be classified for federal income tax purposes. They can either be classified as an employee or as a self-employed, okay? So a minister who is self-employed, they would file a Schedule C on their individual income tax return. Think of this similar as anybody who's self-employed, right? You run your own business, you do your own thing. In the minister world, that's usually someone who's like a traveling evangelist or a traveling speaker, maybe someone who fills in at multiple services, who goes around speaking at different camps and events. That's usually who this self-employed minister is. So the minister could be self-employed for federal tax purposes, or they could be an employee. So an employee would receive all the benefits of an employee, and they would be their income would be filed and reported to them on a W-2. So when would they be self-employed? And I kind of talked about this a little bit. Sorry, I got a little bit ahead of myself. So any income that is earned outside of your regular work for your primary church is considered self-employment income for federal income tax purposes. This is what gets filed on your Schedule C of the 1040, and any expenses related to that is deductible on Schedule C. So any travel, any mileage, hotels, they can deduct against that income. Whenever from just on the income that's earned from the self-employment earnings. So we're talking about outside of the normal work. So this is not the income we're talking about from your primary church where you get a W-2. This is the stuff outside of that. Often churches or often ministers will have both because they'll be paid just on the side to like do a wedding or to speak at some event or something like that. So they usually have both. So for federal income taxes, they're self-employed just on these little side gigs, I guess is how you would say that. So when are they an employee? And this is what most of you are going to see most of the time, especially since I'm talking to, I think, primarily like church administrators, people who are helping their churches with the minister employees, right? So this is that income that is earned primarily from one source. So think this is the pastor at the church. They're usually not the pastor or the minister at multiple churches, right? They have income earned from this one primary source, and that's going to be classifying them as an employee of that church. So as an employee of the church, they get the benefits of all the employees of the church, right? So their income goes on a W-2. They're classified as a common law employee, but they're also available or able to participate in any benefit plans that the church has for their employees. This includes all those nice little pre-tax things we can do with benefits. It includes the fact that your employer, the church, can pay your health insurance premiums for you tax-free. All those things are related to the fact that this person, this employee, is an employee of the church and is not self-employed. So we're not putting their income from the church, from their primary church, on a 1099. We're putting it on a W-2. So this very last point here on this slide is where it gets a little confusing, or can get a little confusing. For a minister employee, income tax withholding is optional. That means they don't have to give you a W-4. You don't have to go through that whole tax table thing to figure out how much withholding. They could have absolutely nothing withheld. Here's the other caveat of that, though. It doesn't mean they're not subject to pay the tax. They just don't have to have it withheld from their payroll. So that can be a little confusing, and people think, oh, I don't have to withhold it, no big deal, I'm not going to owe anything. And then your poor tax preparer, sometimes me, has to tell you at the end of the year, oh, you owed that tax, you just didn't have to have it withheld. Now, as the workers of the church, I generally like to help my employees and say, hey, you're not having anything withheld from your check because you're not required to. Would you like us to withhold anything? And we can help them by getting them to withhold something for their federal income tax, all the taxes that they owe. Because withholding something is better than withholding nothing. They're still liable for that tax. They're just not required to have it withheld from their paychecks. Okay? So, are we all good so far? Oh, look. Someone answered their own question and we're good. Okay. They're still subject to paying the tax. They still owe it. However, you don't have to have anything withheld. So I'm reading a question here. I have someone who's an elder, not under appointment, files a Schedule C for income and expenses from various different churches. Pay them. You don't have one primary source of income. That's correct. You're self-employed. All of your stuff can be put on Schedule C, and all of your expenses can be deducted. That is correct. All right. So let's talk about federal income tax. So now we get to jump into Social Security income tax, which is, remember, we have dual status. So we're treated differently for different things. So there are two ways that employees pay into the Social Security system. This is like across the board, there are two ways. The one most people know about is FICA, which is the second one listed here. And that's the way where the employee has 6.2% withheld for Social Security and 1.45% withheld for Medicare, and the employers match it. That is most employees across the country paying through FICA. But ministers do not pay in through FICA. They pay in through SECA, the Self-Employed Contributions Act. Okay, so the law says that ministers must pay in through SECA and not through FICA. This is where this gets confusing. So for Social Security purposes only, not for federal income tax purposes, for Social Security purposes only, ministers are considered self-employed, and they file a Schedule SE. I understand that's confusing because they're getting W-2, but this is the dual tax status I was talking about. So for federal tax purposes, they are employees. For Social Security tax purposes, they're considered self-employed. Everybody take a breath. Are we okay? Okay, so what that means is your W-2 looks a little funny. So here's what it looks like. A minister will always have something in box 1. That would be your federal wages, right? And they might have something in box 2 of their W-2 if they chose to have something withheld. Now remember, they're not required to have anything withheld, but if they did, it would go in box 2. But a minister, because they are self-employed for Social Security purposes, will never, 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 never have anything in boxes 3, 4, 5, and 6 of their W-2. So their W-2 looks funny. The other thing that could be on their W-2 is in box 14, which is an information only box. So no one's calculating tax based on any of that. They can have housing allowance disclosed there. That's not required, that's optional. But as a tax preparer, I prefer that it's there. Otherwise, I have to ask my minister clients to get something from the church that tells them what their housing allowance is. And that's another step that I have to go through, another step that they have to go through. It's a lot easier for them, in my opinion, if that housing allowance amount is disclosed right here on the W-2. So that makes sense for everybody. I hear the question now, but isn't self-employment tax optional? Well, the IRS has allowed ministers to opt out of self-employment tax. So I didn't do this math for you a second ago. I think I just skipped over it in my head. So a normal employee is having 6.2% withheld for Social Security and 1.45% withheld for Medicare. And then that is matched for them. So for these minister employees who are not allowed to be in that FICA system, they are personally liable for both portions of that tax. So instead of having 6.2% and 1.45% withheld from their check, now they personally are liable for 15.3% in self-employment tax, which seems like a lot, and it is. It's double what a normal employee would have to pay for self-employment tax. That's why this question comes up at all. So you are allowed as a minister to opt out of self-employment tax. Now, the form that you do that on is form 4361, and that has to be filed really quickly into your ministry. So by the due date of the second year that you had minister earnings of more than $400, you have to have filed that form. If you didn't file it, you have missed your chance. You can't come back and file it later. I had a client kind of recently who he was licensed with one denomination, left that denomination, and was licensed with another denomination after a period of time in the middle, and then tried to reapply for this 4361, saying he had just started his ministry or just started having minister earnings. The IRS did not approve that because this form says you have a religious theological belief against socialized insurance. And the two denominations that he was licensed with were not significantly different in belief structure. Okay, so the first one, and I don't even remember which denominations they were, but the first one, he obviously did not have a theological belief against socialized insurance with that one. So whenever he reapplied and tried to say, now I have a theological belief against it, they're like, your beliefs did not change. You worked as a minister for 20 years under this denomination. These denominations are not that different. Now, it is possible that if somebody was licensed under one and moved on to be licensed under another, and they really were dramatically different in theology, like there really is like a conversion between the two, it's possible the IRS could approve this, but they didn't in this situation. All that to say, if you haven't filed this at the very beginning of your ministry, you're pretty much out of luck. But if you are early in, then you do have this option to file this form. So it is not filed with your individual personal tax return. It is filed with separate from your 1040. So now we don't paper file anything, but this is a paper filed form. Your 1040 most likely is going to be filed electronically. In most situations, that's what's required. It is not effective until you get this form approved by the IRS. Okay, so all that to say, you keep filing your tax return as if you owe self-employment tax until you get the approval, and then it is effective back to date of ordination usually. So then you have to go back and amend those like a couple years previous returns. Don't lose the form if you get the approved form from the IRS. It's not that easy to replace. Although I did have a client also kind of recently who was able to track it down in the IRS system and get them to send him a copy. But that was super unlikely previously, but in the last 5 years, I had a client who did that. So don't lose it. So I want to show you a little what this form looks like, just so you can get an idea. So this form, this page here gives us all like the basic information, who you are, when did you get licensed. That number 5 there talks about when you first had earnings, minister earnings. So they're trying to figure out what that due date is, if you're still eligible to file this form with that question there. And then at the top, like box 2 asks, are you a member of a religious order? Are you licensed, commissioned, etc. And then page 2, ooh, this is really hard to read. It's really squished. But at the top of it says, I certify that I am conscientiously opposed to the acceptance for services I perform as a minister of any public insurance, etc., etc., etc. So you're telling them that you're religiously opposed to receiving insurance. And therefore, you're not going to pay into that system where you would receive that Social Security or Medicare benefits. Sometimes, I'm not seeing this as often as I used to, but it used to be that often when you had new ministers in your denomination, people would just shove this form under their nose and say, hey, just sign this, you'll get out of your taxes. And that's a great idea in theory. The problem is this form here says that you're religiously opposed to that. So you can take that between you and God, whether you're really religiously opposed to that or not, and you sign this penalty of perjury statement to get out these taxes. But the second part is they're not always thinking through the end result of that. What that means is, okay, I'm not paying the taxes. Well, that's good. That also means I'm not getting the benefit later. So when I go to retire and I've told the IRS that I am opposed to getting all that money, getting Social Security, all that money, Social Security and Medicare when I retire, that money is not going to then come to you. Like that's what you're saying. I don't want to get that. I don't want to pay into that system. I'm not going to get that. Now, this exemption is only on minister earnings. So this is why I see a lot of times, at least kind of recently, for people who have filed on this, people who are bivocational or who worked, 20, 25 years in a secular job, they've maxed out their quarters or whatever, are going to get their max benefit already from Social Security. I see a lot of people in that range deciding that they're religiously opposed to it. because to them, it's not really going to change their benefits much on the long run, on the backside. But I cannot tell you if you are religiously opposed to it. That is a religious decision you are making, and you are then telling the government under penalties of perjury that that's really what you think. This also means if you have filed for exemption and you've paid less taxes and something happens to you and you get disabled, your children do not get a disability benefit from your minister wages from the government. So you have to think through what your retirement is going to look like before you just decide to sign some form to decrease your taxes. So if you can be smart about that and you can put money aside and invest in your retirement and make sure you have enough funds to live off of, this is not a horrible thing. It's just not a quick, oh, let me just sign this up and decrease my taxes, like they used to say. How can you be conscientiously opposed as a minister but not a secular employee? It's a really interesting question. What this does say is that you don't think you should get public insurance as payment for any of your services as a religious worker. So part of the reason that ministers were not originally in Social Security at all in the FICA system is because the government has tried very hard to separate themselves from the relationship between a church and its clergy. They're like, we don't want to provide for you. We don't want to get in that relationship at all. That is your responsibility. And so that's part of the reason why this has been, and now they were brought into the system in 1969, but before that, they weren't in the system at all. So I will also say before we move on past this point that there have been a couple times over the years when the IRS has allowed for ministers who have opted out to opt back in. Okay, so don't expect that that's going to happen. However, it has happened a couple different times. There's been a couple windows where they've gotten that option to opt back in, realizing, oh, I shouldn't have done this. Someone shoved something under my nose and I signed it and I did not know what I was signing, and to opt back in. I wouldn't bank on it, but potentially that could happen. But if that doesn't happen, then you're stuck in whatever decision you've made on this 4361. And I don't really think, short of some like conversion, that your really religious theological opposition would change. I'm not clergy. I don't have to decide if I'm opposed to this or not, okay? But people who are saying that by signing these forms under penalty of perjury need to realize this is a serious thing. It's not just something flippant. We should just move on and act like it's no big deal, okay? So this is a little example of when you have time to file that form. Remember we said you have to do it by the due date of the second year that you have minister earnings. So Joe is credentialed as a minister in 2022, which was 3 years ago, and that is hard for me to believe. Time is just flying. He earns $5,000 in 2023 and $20,000 in 2024 from being a minister. So he decides that he's going to file this form to get exemption from self-employment tax. His 4361 is due when his 2024 tax return is due, which just finished a couple weeks ago, actually, not even a couple weeks ago, the 15th, last Wednesday. That's when his form would have been due. If you miss that deadline, you're just up a creek. That is not an option that you have anymore. So if this is something you're interested in, or you want your minister to at least know that there's an option, they need to be aware early on in their credentialing process, hey, this is what you want. If this is something you want to do, there's a short timeline here. If this is something you agree with, don't wait till you're later and further on going, oh, these taxes are horrible. I need to sign this form, which is not really a religious opposition to something. That's I don't want to pay taxes. But they need to realize there is a window. It's not forever. You can't just file it whenever you want to, willy-nilly, as you please. All right, moving on past just basic minister taxes. Anybody have any basic minister taxes question before we get into some discussion of income items? I don't see anything else in here. All right. If you think of something later, you can put it in the chat and I'll come back and visit it as we have time. All right. Jail time. This slide is meant to scare you. That's the whole point. So there have been several ministers in the past who have ended up in jail because of income items that they have received from their churches and not claimed as income, and therefore have ended up in jail. So Some of these are kind of funny almost, but I'm going to read over them real quick for you. Reverend Ellis took his pay out of the offering plate. It was not recorded anywhere. No one kept track of it, but that's how he paid himself on Sundays, and he ended up in jail. Reverend Clark had the church pay a whole bunch of personal expenses on his credit cards, including, I believe this is the one that also paid like private school for his children. Bishop Jenright failed to report honorariums, personal expenses, and employer-provided autos, to name a few. And Reverend Springer did not report love gifts. So what's the point of this? The whole point of this slide is, as ministers, there are a lot of things that sometimes are paid for you, paid for them, that we need to at least consider, could this be income or not? I will tell you, in most situations, not these obviously, if something is found that could have been income and it is reported on their W-2 and they pay taxes on it, then we get out of this situation. They don't end up in jail. The problem is when they receive these income items and they're not reported as income because it didn't run through the normal payroll system. Okay, so what is considered income for a minister? There are a lot of things that employees receive, but we're focusing just on ministers here. That is income. Now, income does not necessarily mean taxable income, but any payment from an employer to an employee for the benefit of the employee for their services is considered to be taxable, unless there is a specific IRS code that tells us that it is not taxable. That's a little backwards from what some of us think sometimes. Okay, so we need to start with the premise that everything is taxable. That doesn't sound very fun. I understand that. But when we start there, we're more likely to determine what actually is truly taxable and what is not. And as people who are working for the churches, it is our job, at least partially, to protect our ministers from jail time by correctly reporting all the things that we can that are taxable to them on their W-2 so that they pay taxes. If it is found out that there are things that the church is paying that are taxable to the pastor, but they are put on his W-2 and they pay taxes, we got out of jail. Like the pastor just got out of anything they paid that may not have really been totally correct. Personal expenses, such like that. So it's really our responsibility to look through what really is being paid for those ministers. And if it's being taxed correctly, if we're putting it on their W-2 so that it is taxed correctly. So the first thing I want to talk about as far as income is special things like love gifts. It's Pastor Appreciation Month. I'm sure y'all are going to plan something amazing for your pastors, but you have to realize that anytime that the church solicits funds, ooh, what about the church paying for schooling? Are we talking about seminary? Kevin, we're talking about seminary? I will come back and circle that. It's actually here in a second on one of these slides, so we'll cover that here in a second. So love gifts that are contributed, that are collected by the congregation at the what's the word I want to say? The church asked for offerings, said, hey, we're going to bless our pastors, give money, right? A church solicited, there's the word I was looking for, is taxable to your pastors. So any love gift for any special occasion is taxable to your pastors. Now think about this. No employer, this is not church specific, this is not religious organization specific, no employer can pay a gift to their employee tax-free. None. There's not usually a problem with that in the secular world. My boss gives me a bonus, guess what? It goes on my W-2. This isn't like some secret, right? Where it gets a little different is in the religious world, we want to call them love offerings, or we want to call them something else. But the truth of the matter is, those gifts, in most situations, like more than 95%, we're paying them, we're providing them a gift. Why? Because they provided something for us, right? They ministered to us, we benefited from that. So we're paying them for a service they provided. I understand we don't want to put minister duties as a service, but that's what their job is. So that gets a little weird, and I understand the hesitation there. However, when we're paying them money for doing something that they're technically paid to do, That is compensation to them. There are very few exceptions to this, and I don't even know if I covered this topic in this, I don't think so, in this presentation. But the other thing that has to be considered here is reasonable compensation. So the IRS requires that churches and nonprofits pay their officers, directors, top employees reasonably for what they are doing. So that's determined based on comparing compensation between similar size organizations, so like similar size churches. How that relates here is that the church cannot just be a conduit for members. The church has to control how much money they are giving to that pastor, even the love offerings. Even the love offerings. Because if we pay them an amount that makes their compensation be unreasonable, now we have a whole different can of worms that we're in trouble with. It's called an excess benefit transaction. It gets really muddy and really messy really fast. So the church needs to control the amount of money going to the pastor. Now, that's all talking about love gifts that have been solicited from the congregation, ran through the church. We gave it to him on his paycheck or separate check, it doesn't matter. It goes on his W-2. That all needs to fall under reasonable compensation. Can be cash or non-cash. The church has to control the amount. That's where the reasonable compensation thing comes in. What if someone decides to give your pastor $100,000 for pastor appreciation through the church? I'm pretty sure in most situations, and maybe I'm a little off here, that would probably make his compensation unreasonable. If suddenly he made $100,000 more than he was supposed to make, okay? So we have to be very careful that the church controls those funds. The church has to control those funds. The flip side of that is, if the church does not control how the funds are used, the donor does not get a charitable contribution. Okay? So when a contribution comes in that is restricted, that the church does not have control of what those funds are used for, it is not a completed gift. It is not a deductible contribution for the donor. So we want them to get their contribution receipt. We want our pastor to receive reasonable compensation. You just got to be careful here. You just be careful. So this is going to include cash or non-cash gifts. Also, I will tell you, as the accountant at my church, when it's Pastor Appreciation Week or whatever, and we say, everybody bring your love offerings, bring a card for the church, blah, 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 for the pastor, put it in a bin or a bucket, whatever. I take that bucket to my office and I open up all the cards and I pull out all the money because I need to put that on his W-2. We solicited those funds. He's getting that money. It's going on his W-2. Sometimes it means I add it as a bonus to his check. Sometimes he gets the cash and I just do a non-cash fancy, magic in the system to make it be in his wages. But that is the church's responsibility if the church solicited the funds. A little bit different if some member just goes up and hands him a check. Now, it's still taxable to him. The church just isn't responsible for it. Does that make sense? If someone could send it directly to him, okay, we just gave it to him. So the pastor should know that all of that is taxable. And that type of gift, where would he put it on his tax return? On his Schedule C with his other minister earnings, okay? So either the church needs to keep track of it all and put on the W-2, or he needs to pick it up on the Schedule C. Either way, it's taxable. These love gifts are taxable. The only way it is not taxable, the only way is if there is a relationship outside of the church, of the congregant church, pastor-congregant relationship. So like if he got a gift from his brother, okay, that would not be taxable to him. But within the church, if the relationship is based in the church, in his work in the church, that's going to be taxable to him, and it's going to be reported either on the W-2 or the minister needs to pick it up on their personal tax return. All right, moving on. Non-taxable for relative or close friend, and I just said that. And here's the key for non-taxation: detached and disinterested generosity. It can't be at all related to something that God minister did for you. Even if it was 10 years ago, they helped your family out. It cannot be connected to a service. If it's connected to a service, it is compensation. All right, moving on from gifts to housing allowance. So Housing allowance is a portion of a minister's compensation that is not taxable to the extent that it does not exceed certain limits. Okay, so usually it is not a bonus. Usually it's just we're taking this $100,000 you're making and we're splitting it. A portion of it we're designating as a housing allowance. So what does that mean? So it can apply whether we give them cash or if they live in a parsonage and there's outside expenses that we also cover for them. Okay, so here's the organizational issues. Here's what you do on the church side. So in order for a minister to have a portion of his compensation designated as housing allowance, there's three things that has to happen. Number one, the employer has to designate it. That's easy enough. Usually it goes in like, there's usually an annual compensation setting meeting with your board or whoever to designate how much is being designated as housing allowance. Usually this is the way this goes. Your minister has a form to fill out every year. He gives it back to you and says, I think $25,000 of my income can be used for housing expenses. And you say, that sounds great. We're going to designate that. Okay, it has to be designated. And it has to be designated before it is paid. You cannot, after the fact, at the end of the year, go, oh, I had more housing expenses. Can you just like do some magic and rearrange numbers and make this be housing allowance? That's not what the IRS says. It has to be designated in advance of being paid, and it has to be designated in writing. So this is where those board minutes come in, board meeting minutes come in, or the compensation committee minutes. Designated in advance of being paid in writing. It can be changed mid-year. That's fine, not an issue with that. But it has to be designated in writing. And that change needs to be designated in writing. Okay. So more
Yeah, and
organization.
Sandra, when it's changed
Yes.
mid-year, you can't, like, the amount doesn't retroact to the prior part of the year, right? It's only
Correct.
from that point on.
Correct.
Right.
So they can say, oh, you know what, we're buying a house. We're going to have more expenses this year because we're buying a house. And instead of my total being 25, I need it to be 40 this year. And then you work with whatever compensation is left to designate it so the total is 40 for the whole year and do that math. I will tell you, if you change it mid-year, make sure that you put a note or set a reminder or something that you change it back. But because we're changing mid-year, assuming that's not going to be the same going forward, when we add an excess, we have to be careful because, okay, let's say we had $15,000 extra housing. Now, a really big portion of his paychecks for the next 3 months is going to be housing, okay? If we don't touch that in January, his housing is going to be way more than we thought it should be, right? Because once again, we need to figure, here's the annual, split it by his checks. So just make sure you make a note to like, okay, in January or December, we need to figure out what this really needs to be for the next year. And usually annually, you're getting a housing allowance designation to approve anyways. But yes, you can change it mid-year, but it can only be proactive. You can't ever go retroactively and change. The only time you could do that is if it was designated in time, but just the system didn't get updated in time. So like it was designated in January, but it didn't make it to HR or whoever's doing payroll. And so it was designated, the system just had it wrong. If that makes sense. So we could fix it that way because of an administrative error, but otherwise we can't go retro. So the cool thing about housing allowance is it's not reported as taxable wages in box 1 of your W-2. So you just decrease your federal taxable income by this housing allowance. That's pretty cool since their taxes just went through the roof because they're paying 15.3% on everything for self-employment tax. So this is one small way, and it's definitely not dollar for dollar, but one small way that your taxes can decrease is by having housing allowance designated. The church should not ask for an accounting of how those housing funds are spent. I've seen churches do this and try to manage that, and it just makes a mess and it's not needed. It actually increases the liability of the church for you to then determine if they used it right. Put that on their tax preparer. That is the minister and their tax preparer's responsibility to figure out if they used it right. And make sure you're only paying housing to someone who is properly classified as a minister in your system. If the IRS sees Social Security and Medicare taxes withheld and matched and housing, big red flag. I fixed many a W-2 that I got the W-2 to the 1040 and was like, your W-2's wrong. We got to go fix it. So those two things do not compute. They're mutually exclusive. You cannot have housing allowance and FICA withheld. You can't do it. Your system will let you, depending on how you set it up, but not the way. That's not allowed according to IRS rules. Okay. Let's see. Not paid to anyone who's having FICA Medicare taxes withheld and matched. That's what I just said. So is it taxable? As I just said, going too fast. For federal income tax, the amount that can be excluded is not taxable. So the amount that's designated as far as the church is concerned is not taxable, does not go in box 1. If for some reason they did not use their housing correctly and they have excess, that gets added as to taxable income on their personal tax return. W-2 is still not adjusted. We don't change the W-2 for that, okay? That's nothing you need to do on the church side. That happens on the minister's personal tax return side. For self-employment tax, the full amount is taxable, okay? So housing allowance just gets you out of the federal tax on that piece, does not get you on the self-employment tax. If you're exempt from self-employment tax, like we discussed earlier on the 4361, you're also exempt from self-employment tax on the housing allowance. All right, so housing allowance is not taxable to the extent it does not exceed the lowest of. So there's a three-prong test. So those three things is either the amount designated, the amount spent, or the fair rental value of the home as furnished plus utilities. So this fair rental value piece came in, my years all blend together, more recently than the others to try to make this a reasonable designation. What they didn't want is they didn't want these ministers to get the benefit of excluding all their income and then just spending like crazy extravagantly on housing in order to not have federally taxable income. So this fair rental value just keeps this kind of reasonable. It would be reasonable to provide your house. Okay, so it has to be the lower of the three. If your fair rental value is kind of low, furnished plus utilities, then you just need to be careful as to how much you're designating. So it doesn't matter that if you have excess housing allowance. The place that it matters is if for some reason you have your ministers set up having tax withheld according to like a tax table, which you can, they can provide you that information we talked about earlier. You're not required to, but you can. Then when you take this housing piece out of what is federally taxable income, their withholding goes down. That's okay as long as that's really legitimate housing allowance. If it's not, that's a problem because now potentially we'll owe more tax later because we have this piece that we thought was taxable, was not taxable. Now it's getting thrown back in as taxable because we didn't spend it correctly. The fair rental value is too low or something. I will tell you, this fair rental value is furnished plus utilities. Furnished plus utilities. So people can go to a lot of work to make that fair rental value be a high number if they would like to. It requires some work. I have a client who, it's probably been 10 years now. He decided he wanted to get geothermal energy in his house. So it was like $40,000 or something to get this, whatever, totally not anything I know about. Okay. And he wanted it to fit within his housing expenses. So he went to a lot of work, and this is not illegal. This is it's allowed. He went to a lot of work to make his fair rental value high. How did he do that? Well, he got a fair rental value of the house. There's step one. Then he went to rental places that rented furniture and had a list of all the major furniture in his house and figured out how much it would rent for on a monthly basis. And so in doing that, he bumped up his fair rental value piece quite substantially by doing that work. Most of my clients don't do that work. They don't care. But this client, he wanted this to fall within his housing allowance, so he did that. The best way to get a fair rental value, I see that question, is to find a realtor that you know in the area and who is independent of you, not your brother or your sister, independent of you, and get them to give you a fair rental value. It's a little bit hard. Sometimes they can give it as furnished if you're in an area where they have furnished rentals. That's not that easily available sometimes, depending on where you live. But I would start with the fair rental value. I would start with a realtor to give you a fair rental value of the home. I will also tell you that most furniture rental places, without you going to like, here's the list of all the furniture in my home, will tell you about how much it costs to rent furniture for a 3-bedroom, 2-bath house, something like that. So they can give you an estimate to get you close. This fair rental value should probably be redone every 4 to 5 years. It kind of is going to depend on the market and how the market changes. Recently, housing's been a little crazy. If your fair rental value is kind of old, 5 years old, I would probably get it redone. I mean, the market's leveling out a little bit now, but my house that we bought 12 years ago is worth twice what it was worth, at least twice, almost 3 times what it was worth when we bought it. So when the market goes up, for sure, get a new fair rental value. I mean, to your benefit, right? To be able to get the best benefit out of that. Okay, so what's valid housing expenses? It's supposed to be how much it would cost to provide your home. Okay, obviously includes your mortgage payments, also would include rental payments if you're renting. Utilities, base rate of phone. This is not your cell phone. I don't know who has a home phone anymore, but if you do, the base rate of your home phone, you know, the one that like plugs into the wall, that one, can be included here. Furniture and decorating items, cleaning supplies, repairs and maintenance, payment on home equity loans when the loans were used to renovate your house. So you can't just use payments on home equity loans used to pay off your credit card expenses. Okay, so the use for the loan had to be house renovation related. Okay, insurance and taxes. Make sure you keep track of this. If you're audited, the IRS is going to want to see it. Either this or your fair rental value, whatever you use to exclude that income, whatever the lower was, the IRS is going to want to see it if you get audited. So make sure you keep track of it. You know, receipts from like Home Depot and places like that, over time, they like rub off and the ink disappears and you can't see anything. Scan things, create electronic documents. You don't need paper receipts of everything, but you do need documentation if you were ever audited for those expenses. So we talked about this. Guess I jumped ahead. I think it was based on your question. Okay. Here it is, local ads, online system, rental companies for furniture. We talked about this. Every 3 to 5 years, you should redo it. Just because, and honestly, most of the time, especially in the way the market is right now, that's going to increase your fair rental value, which is going to increase the amount that you can deduct. You can designate as housing and decrease your taxable income. Okay, here's a little housing calculation just for all of you people who love examples. So this person had $25,000 designated. That's what was like on the paper sign, whoever approved it, whoever blessed it. Then you have $30,000 of housing expenses, but his fair rental value was only $20,000. In this situation, he has $5,000 of excess housing allowance. Okay, that gets added back into his federally taxable income on his tax return. The full amount of the $25,000 gets included in. All right, on his Schedule SB. There's a little disclosure, and I used to have it memorized because we used to have to physically type it every time to add it onto our tax return. But this disclosure we have added to our 1040 returns as long as I've been here, so 23 years, to tell the IRS that there's income items they don't know about. And the only reason that that is helpful is because when the IRS pulls 1040s for audit, it's a math game. It's a numbers game. So if something doesn't make sense numbers wise, like they're saying their deductions are really, really high, but their income is really low, that triggers somebody to pull this return and look at it and be, okay, what's going on? This statement, which says that your minister got housing allowance, tells the IRS there's income on there you don't know about. There's income received that you don't know about. So these deductions really do still make sense into what passes the smell test, to use those terms. So then the IRS knows what's going on. Excess housing allowance gets entered at different places depending on your tax return or your software that you use. It used to go right on line 1 in like TurboTax. Now they've changed the 1040 a couple years ago. It's about to change again. And it goes down on the bottom line in where all the wages are calculated. There's like an other line. It just says excess housing allowance and it goes there. So just add it back into your federal wages or your W-2 box on your return. So it depends how you're doing your return. The software often will have the calculation itself in the software, and so then the excess just goes where it's supposed to go. Okay. All right. If you live in a parsonage, this doesn't happen that much anymore, but I actually had a client who just bought 2 houses to provide parsonages to some of their employees. But it's been a while since I've seen parsonages. But if there is parsonage that you're living in that the church owns, the church's responsibility is to determine the fair rental value of that parsonage. The reason that matters is because just like housing allowance is subject to self-employment tax, the value of that parsonage is subject to self-employment tax. So as a minister, you have to add that to your Schedule SE as self-employment income. It doesn't go into the federal income tax, just goes to Schedule SE, okay? So you have to include the fair rental value of the parsonage on your Schedule SE unless you're exempt, obviously. Okay. So it's the church's responsibility to provide a fair rental value. A couple years ago, I went and did a minister's retreat of sorts down in the Galveston area. And there was a person there who he had lived in a parsonage for 30 years, I think. And the church had never told him the value of that. And they told him it was his responsibility to do that. That is not true. This is a part of the compensation you are providing to the minister. It is your responsibility to tell him how much that is so he can pay tax on it correctly. Okay. Housing allowance and child tax credit. This is a little nuance we kind of ran into a couple years ago with one of our taxpayers. So the amount of child tax credits that you get is determined on some calculation of the income that's on your return. If your income is not high enough, you don't get the full child tax credit, which, okay, that makes sense. The child tax credit is refundable in most situations. So what we found is that sometimes if a minister has multiple children and a potentially large child tax credit, it's beneficial for you to look at those numbers to estimate what that would be so that your housing allowance is not so much that it is limiting your child tax credit. Okay, so just something that needs to be thought about and thought through kind of as we are talking about housing allowance. All right, any more question on housing allowance before we move on to tax-free fringe benefits? Let me see if I have any questions. Okay, I answered that one about excess housing allowance, talked about fair rental value. Would expenses for home improvement also be eligible? And exterminator, yes, the exterminator services. Yes, pool maintenance, security system, whatever it would take to provide your home. That's
Not a
kind of
personal maid.
not your
Right.
personal maid. Sorry. However, you can deduct a
Supplies.
cleaning service.
The supplies. Oh, really? Okay.
So you can deduct a cleaning service. You cannot deduct the payment to her to do your laundry or any other personal services she provides. But you can deduct the cleaning service to come clean your house.
Good to know.
But like I said, you have to separate personal services. So if you pay them to clean your house and pick your kids up from school and do the laundry and cook dinner, you're going to have to find a way to split that. And I need that person at my house to pick the kids up from school and do laundry. Anyway. Okay. All right, moving on to tax-free fringe benefits. Tax-free fringe benefits. I will tell you in most of these situations, as you can see right here on this slide, there's this very important word at the very beginning, and that word is qualified. What does that mean? That means that you provided the benefit according to the IRS rules, and there are a lot of rules. So if you have these plans, retirement plans, tuition assistance plans, dependent care plans, tuition reduction plans, make sure your plans are set up according to the IRS rules. If they are not set up correctly, then that gets rid of your tax-free fringe benefit, okay? So these things can be tax-free if we set them up correctly. Qualified retirement plans such as 403Bs, that includes any payment to the 403B for the employee, from the employer to the employee. Cars that are used for business or mileage reimbursements. Mileage reimbursements have to be substantiated, and we're gonna get to this a little bit more in a second. The IRS rate right now is 70 cents a mile, which is ridiculous to me. I mean, I guess gas is up and down, but that's crazy. Life gets more expensive, I guess, but 70 cents a mile, and those miles need to be documented as to what the business use was. Commuting miles are never deductible. If you happen to pay that for a minister, like from their home to the church, that is taxable to them. Life insurance, this is group term life insurance, not to exceed $50,000 of coverage under a group plan. Not specific to churches, that's available to all employers, as is the retirement plans. Qualified tuition assistance, qualified dependent care plans, qualified tuition reduction plans. Remember, if something is a dependent care benefit or a tuition reduction, depends on the program. So dependent care is a daycare. That's not a school. That's a daycare. So watching kids who usually are preschool age or in after school programs, there are limits on all of these annually. You do have to be kind of careful to make sure that these qualified plans are not just in favor of the highly compensated, nor for them to stay tax-free. So if the only person who gets the benefit is the senior pastor, usually you end up with an issue that makes this then taxable to him. Non-discriminatory health benefits. Non-discriminatory is a big thing to make sure you're not discriminating and only providing it to the pastor. Life insurance, I mentioned that, 403Bs. I think I went through all of these. Any questions on that while I'm just skimming over? No, I don't see any questions on that. All right. Business expenses. I think I'm going to remember, I'm telling myself, I'm going to remember to talk about seminary payments here in a second on this slide. Hopefully I can remember, somebody can remind me if I get carried away on something else. Business expenses. The following may be considered a business expense. No. Before I start here, let me tell you that in 2018, with the Tax Cuts and Jobs Act, President Trump and that lovely tax bill got rid of a deduction on the 1040 for employee business expenses. What that means is that these business expenses may be reimbursed by your employer. If they're not reimbursed, there's not another place for you to deduct. There used to be, it was limited, but there was an option for you to deduct them on your personal tax return if you didn't get them reimbursed. So to that end, I would recommend that your ministers and all the other employees get reimbursed whatever they can get reimbursed from their churches, from their employers.
What about on their self-employment return, Sandra, though?
So your self-employment expenses have to be directly related. So you cannot deduct these from, let me tell you what I was thinking because I just stopped in the middle of my thought.
Sure,
So
sure.
self-employment income, which includes all your income, remember, includes your federal income and your housing. You can deduct these expenses against your self-employment income. You cannot deduct them on Schedule A anymore. That deduction has gone away. But also remember, any travel expenses that are directly related to that other self-employment income, like speaking fees and weddings and all that, that all gets directly deducted on your Schedule C. But you can deduct these on your Schedule SE. Now I'll tell you the other caveat of that. Those deductions are only deductible if they're not reimbursed or reimbursable. So if you could have gotten them reimbursed, but you didn't, they're not deductible there. That's what the IRS instructions say. If they're reimbursed or reimbursable, you cannot deduct them. So the only thing you would be able to deduct there would be if the church has like a cap on how much they're going to pay for business expenses and you exceed that cap. So they're like, okay, you hit your $2,000 limit for the year or whatever. Then that excess would be able to be deducted there on Schedule SE. But if you could have gotten it reimbursed and you just didn't, shame on you, get it reimbursed. That's your best bet. So these things may be considered as a business expense. May. It really depends what you're doing with it. Books and magazines for study, mileage to and from hospitals, member call meetings, remember not commuting just to the hospital, just between churches if you're working at multiple congregations or something like that. Office supplies, conference fees, continuing education, travel, and your cell phones with caution. So let me talk about continuing education for a second because I saw that question earlier. The IRS says, and this is not specific to churches, this is specific to all employers. Remember we talked about a little bit on the previous slide about qualified tuition assistance plans. Totally different thing. Those plans for sure cannot be in favor of the highly compensated. So, for example, my boss thought about going back and getting her master's because she doesn't have it. And so by the time she thought about it, there was no one else in the tuition assistance plan. So she couldn't do that at the company's dollar because it would favor her. Okay. She should have done it while I was still in school, and then there would have been more money out there that wouldn't have favored just her. Okay, so if you have a tuition assistance plan, that's the best way to get your seminary paid for. Because what the IRS says is continuing education is just that, education you need to help you with your job. However, expenses that lead you to a degree is not continuing education. If it leads you to a degree or a different position, a different job, it's not considered continuing education or business expense. It's considered a personal expense because you're getting a personal benefit out of that education. Does that make sense? So anytime you are paying for seminary, most of the time, that's going to be a taxable item to that minister because they're getting a degree. Like that's the whole reason they're going, right? To get their master's in divinity or whatever their next degree is. So continuing education, think like conferences, think like if you paid to attend this seminar, I don't know if you did or not. Those type of things would be able to be deducted or reimbursed. Travel, you have to be careful, obviously, not personal travel. If you go on missions trips and such, you got to be careful. There's not a personal piece in there. Missions trips that turn into vacations, you have to be really careful. There's a lot of very specific rules on the travel expenses that could have a personal benefit. How do retired clergy exclude income for their housing when their only income is Social Security and pension? They don't, unless they're getting a pension from the denomination. So if you have a denominational retirement plan, payments made out of that to you can be designated as housing. Now you designate that at the retirement plan place. So that's who you tell, that's who designates your housing. It comes to you on a 1099-R showing it was distributed from them. And the taxable box is actually left empty because then it's left up to me or your tax preparer to determine how much of that was used for housing. So that's the only way you can have income designated as housing is you have to be receiving pension payments from a denominational plan.
That's a 403B, right?
Correct.
Right.
Not your IRA,
Right.
or any type of individual retirement. It has to be coming from your denominational plan. So your 403B.
If we have a second, Sandra, I had a question come up a couple of weeks ago. So somebody that had a 403B and they had I don't know, let's just say $10,000 for argument's sake in it. And they got to, I don't remember what the amount was, and they got to retirement and had all this stuff and this other IRAs and all this stuff. And so they moved a bunch of that into the 40, they moved it into the 403B.
Moved it in?
Yeah.
And didn't move it out. I'm surprised they didn't move it out. That's normally what they do.
Yeah, they moved it into the 403B so they could use whatever they calculated for housing. Is that?
I don't think that's allowed.
Okay. Okay. I wondered. So.
That's just my gut check. I mean, I can look into it, but
unless they were originally earned, unless it was originally earned in the.
Yes, usually it has to be originally earned in your ministerial. That's why it makes sense because instead of you receiving the income, you deferred it to go to this retirement.
So I think it was. I think they were just keeping a minimum though in the 403B and moving it to something else, in the years prior. So anyway, okay, thank you.
That's what I think. That's my gut. All right. So travel, make sure it's ministry related. Cell phones with caution. The IRS has actually changed their opinion on cell phones kind of recently. Usually when we're paying cell phone expenses, what the IRS wants us to do and how they want to classify those payments, it is not a part of your compensation at all. Payment of cell phone is considered a working condition fringe benefit. Okay, and so what that means is that you have, in order for them to reimburse your cell phone, you basically are telling your employees that they have to have the cell phone to do their job, which depending on how on call some of these people are, that's probably pretty true. And now, I get a reimbursement for part of my cell phone. Every single software we get into has some two-factor authentication, whatever. If I leave my cell phone at home, I literally have to go home and get my cell phone so I can come back to work and get into all my softwares. So I definitely need my cell phone, but it's considered a working condition fringe. So basically that means you're saying that I'm providing a portion of this for you because you need it to do your job. You have to be really careful in paying cell phones as working condition fringes for hourly employees. Because now you're almost saying my employee is potentially on call at all hours, and now I need to be paying you for being on call, it gets really muddy really fast. So just be careful. You're okay with your ministers because your ministers are not subject to overtime and minimum wage rate rules and all that stuff because of the lovely exception, ministerial exception. You're okay with that. Be careful if you're doing it for hourly employees because it can get kind of muddy there. All right. Auto expenses. So there are multiple ways you can pay auto expenses for an employee. We have about 20 minutes. I think we're going pretty good. Okay. There are different ways you pay it, and the way you pay it will determine how it is taxable. Okay, the first is a flat allowance. I will tell you, anytime that you pay a flat allowance for anything, it's taxable. That means there's no substantiation. That means no one's looking at it. We're just giving you money for a purpose, and whether you use it for that purpose or not, I don't know. We never ask about it. Those are taxable. I do also want to throw in here, which this is not about autos, but flat allowances triggered in my brain. Moving expenses are taxable. They've been taxable since 2018 with the Tax Cuts and Jobs Act. Originally, that was a temporary fix through 2025. It is now made permanent with the One Big Beautiful Bill Act. Moving expenses are taxable. If you pay expenses for your person to move, that is great. Make sure it goes on their W-2. Okay, if you reimburse mileage, the rate is 70 cents a mile. Make sure it's properly documented. From my house to the church is not business mileage. Why am I driving? Am I going to visit somebody at a place? Am I driving to a conference? Reimburse it at the IRS rate. I will tell you, I still see people trying to pay for people's gas. Please don't do that. The 70 cents per mile is actually intended to cover the wear and tear and depreciation of your car in addition to gas. That's why it's so high, or in my opinion, why it's so high. Paying someone's gas, like giving them the credit card to fill up the tank, is very, very difficult because you can't prove they used 100% of that gallon of gas for that business purpose. There's almost always a personal piece in there. So please, please, please don't do that. Make them submit mileage receipts, documentation, and reimburse them with the IRS rate. They actually get a better deal out of that usually. I will tell you, the IRS says you can reimburse up to 70 cents a mile. If you choose to reimburse at a lower rate, you can do that. You just cannot reimburse at more than 70 cents a mile and it still be tax-free. If you reimburse higher than that, the excess is taxable. Employer provided autos. There is a nice little chart that the IRS gives us that tells us what the annual lease value is of that car that you're providing. Basically, what should happen is your employees should be keeping track of their mileage, how much is personal, how much is business, and then at the end of the year, you take the annual lease value and multiply it times that percentage and add that to their income in box one. If there's no mileage kept and no accounting for any of it, then 100% of the annual lease value is considered personal for your employees. So do I turn in cell phone expenses on an ARP or is that its own line? So usually, speaking of cell phones, oh look, I jumped ahead, but here's that whole working condition fringe information I mentioned earlier. Usually the way that works is what we recommend is that you determine an amount that you're going to reimburse for cell phones. So you pick your limit as the employer that you're going to reimburse up to whatever per month, whatever. And then what we recommend is that you have the employees provide a copy of their bill, their phone bill for 1 month for them to determine that it's reasonable. Because here's the thing, if you're reimbursing them $100 a month for their cell phone, we need to make sure they're actually paying $100 for their cell phone. Because if we're paying them an amount over that, that's personal and taxable.
I think for most of our clergy, Sandra, it would be in the ARP, and then it would have to be justified with receipts.
Okay.
Like you're talking
We just
about.
don't always recommend or don't require that it gets
Yeah.
like I don't provide a receipt every month to my employer. Like once a year, I provide a receipt and they determine the amount that they reimburse is less than what I'm paying.
Yeah, and that's probably fine on the ARP for that too, I think.
Yeah.
For
So
that
I don't know what
particular
the
item.
form looks
Yeah.
like. But yeah, and I mean, back in the day, back in the day, we had these nice cell phones actually listed like every single doggone call. And we like tried to figure out how many calls were ministry related and how many were personal related. And oh my goodness, that was so complicated and a lot of work, especially if you have a lot of employees. Basically, the IRS is just trying to say, make sure you're just paying them a reasonable amount if you're reimbursing cell phones and not more than 100%. That's where the substantiation comes in, I think. Because like I said, if you're paying them an amount more than what they're actually paying for it, now we have personal. All right. We have a home office question. If the church does not provide an office, you use your home office. Is mileage to and from the church always for a business purpose deductible? I think it depends what your job is. I mean, usually the IRS is looking at where's your tax home? Where's your office? If they don't have an office, it just can get really sticky. I had a client who had a home office and it was split like 5 ways between 5 different jobs. And because, okay, if you have a home office, like you don't have 5 home offices, like one to pay your bills in and what, like you don't, right? You have one home office. You use it for everything. The kids use it to do their homework in, like, it's the home office. So just to be careful that you have a place, home office for tax purposes is defined as a place that is used regularly and exclusively for those purposes. So you gotta just be careful. I think that's often where the IRS falls is that, well, this may be a home office, but you used it 2 hours a week for this one purpose. I'm not sure you're commuting to the church is now a business expense. So you just have to be careful there. Can the phone allowance cover the cost of the phone itself or just the monthly service? I don't like this question.
A lot of times the payment's built into the bill, right? I mean,
That is also true. That is also true. You have to be careful. I don't think there's been a ruling on this that I remember. I just get really leery with the church paying for a whole new phone for somebody. I mean, let me just be honest. Because there's for sure personal use to that phone. Like for sure, unless you're carrying 2 cell phones. And I actually saw somebody doing that the other day, but it doesn't happen that often. I just think you have to be careful. You just have to be careful. I'm sorry, that's not a good answer. And I tend to go more conservative than more, just pay everything. You just gotta be careful. Sorry, didn't answer your question. I'll look and see if I can find some rulings to tell me something about that, and get back to you, or you can email me and I can do a little more research. So accountable expense reimbursement plans is the best option. Obviously, if it's an accountable reimbursement plan, if you know your English, you know that means there's accounting. Somebody's giving you receipts and we have to document why this is a business expense. For any expense more than $75 or more, the IRS requires that there is a receipt. I had a client the other day. If you're my client, you do something really stupid, I'm kind of sorry because you end up being examples. So I love telling you about your name. I had who said, is a credit card receipt and receipts the same thing? No, they're not. You need to actually have the receipt from when you spent whatever you spent. Yes, the credit card will tell me how much was charged, but that doesn't tell me the details of what you spent. Anyways, so make sure that receipts are provided and things are documented. Gotta be careful with cash advances. We need to make sure we're fully documenting how we're using that and that any excess cash is returned. A cash advance that is not documented and excess is not returned is taxable. 100% of it is taxable. Got to document how they're using these funds within a reasonable time frame. 60 days is usually a good time. I try to tell people, hey, if you don't give me receipts by the end of the year, which, okay, that would be like, the last quarter receipts, then I'm going to put it on your W-2. And I just threaten that once, and then suddenly people show up with receipts, or they just know that it's taxable income to them. They've got to be careful when people have the credit cards and just able to just use them willy-nilly however they want to. They've got to be providing substantiation. You are responsible for how the funds of the church are used, and they can't just be used for people's personal whatever willy-nilly all the time. We've got to be documenting how we're using those funds, or we're responsible, to the donors, to the public for what we're doing with those funds. All right, let's see what else we got. Non-accountable reimbursement plans. This means there's no accounting. Does everyone immediately realize this is a bad thing? Bad thing. I just hear it coming bad. So if there's not accounting, obviously it's taxable. No accounting. We handed you money. What I'm seeing a lot is discretionary spending accounts. Not a lot. Not as much as it used to be. But if there's an account that nobody sees at all except for the pastor, and he just gets his money to just spend it, we have a problem. We have a problem. Um, and that's taxable to the pastor. You've got to have some documentation. I know that are some things that pastors are privy to, the rest of us are not. But to cover your pastor and get your pastor to provide some type of documentation. Usually these discretionary spending funds often is like, he has kind of a pool of money he can give out for benevolence purposes. That's where I see it the most often. He's got to document something. We got to document who we're giving money to, why we're giving to. This is not public information. It's not being posted like on the screen in the middle of service, but someone needs to know how this money is being spent, or we just assume the pastor got it all. And as much as we would like to trust our pastors, we've got to realize we've got to protect the church. Someone has to know what is happening with these funds. They can't just be, oh, here's your money to spend all the time. So a non-accountable reimbursed plan is basically we give you money and it's not really accounted for. So you just got free money. So if that's the case, it's all taxable to the pastor. It's all taxable to the pastor. So we mentioned this earlier. I guess we got a little bit ahead of ourselves. Will out-of-pocket business expenses be fully deductible for SE tax? As we discussed earlier, yes. For federal income tax, no. That went away in 2018, which is now 7 years ago. Okay. Making tax payments. This is my last slide, so I think we did pretty good on time here. So if you have any more questions, be thinking about those, get those in the chat. Making tax payments. As much as I told you earlier that ministers are not required to have tax withheld from their check, I honestly think that's the best option for them. They really need to get with their tax preparer and do a tax estimate, estimate how much they're going to owe, and get it coming out of their check. Out of sight, out of mind. I mean, some people do not want the IRS to have their money, and I get that. But if you did a good tax estimate, then you're going to be paid in when your tax return is finished. There also is an option to pay by mail, although that is going away quickly. The IRS strongly encourages electronic payments and not through mail for your tax payments. I will tell you, when COVID shut the world down, the pandemic shut the world down, there were checks paid by my clients to the IRS that were not cleared or opened for 3 years because they had trucks of mail they didn't even open. Electronically is just your best bet this time. Things are just getting lost in the mail. And electronically, you yourself can specifically say, this is where I want this applied. Whereas if you send in a check, you're just at the mercy of whoever happens to open that mail and what level person is doing the data entry. You just got to be careful. So definitely need to make your tax payments. You still owe the tax, but there are options for you to make tax payments a different way, kind of however you want to. Electronically is the best bet, in my opinion. Here's some resources for you. Not including Elaine's book, which y'all saw a little bit earlier. I think it's actually on the next slide. ECFA gives some good advice. The Church Network, Church Law and Tax. We have one more. Oh, the Co-op Ministry Conference, which I really highly recommend. They are not denominationally based at all, but they have a conference annually in Houston in February. I'm actually speaking at it this coming up year. I'm doing the minister's tax session, and then me and Elaine are doing one on fringe benefits. I think she's teaching on, what's her other session on? She's doing one on maybe worker classification. But just a really good resource. It's an all-day conference at a church in Houston. Really good place to go and just be with other church ministers. This conference actually covers the gamut. So there's a whole section on like facilities maintenance, but there's also HR and tax stuff too. So anybody in your church really can go and enjoy, and enjoy from that conference. Here's Elaine's book and the information on it. I'm pretty sure you can get it.
Are y'all doing TMF again this year? Do you know?
We're also doing TMF again.
The webinars.
Or let me see if I have the dates written down.
It's a little more detail just on some of the, there's 2 sessions, but a little bit deeper.
On the 10th of February, 2026 is Elaine's church session.
Okay.
Which I think it's 4 hours long. I think that's correct.
Yeah.
And then I'm doing this minister's session again. It's 2 hours long, so there's a little bit more in that one.
Right.
Not much, but more questions throughout on the 17th. I don't have times for those, but that's the 10th.
There's a little bit of cost with that, but not bad. It was like $20.
No, it's not bad. The 10th and the 17th of February for those. So,
Awesome.
all right,
And yet,
anybody else have any questions or anything before I
do. Can you hear me, Sandra? This is Brenda.
can?
We are a small church, and this is the first year that we've offered our pastor a housing allowance. So
Okay.
I have been writing his check with no deductions to it at all. We just gave him a bonus, and because it was beyond the housing allowance, I deducted Social Security and Medicare, not withholding. So it sounds like I need to reimburse to add that back in. Is that correct?
Yes, and hopefully
Okay.
you didn't pay that to the IRS or put it on a
No, I
941.
haven't reported it yet, thank God.
Awesome. Yeah. So just pay him back for the tax that was held, or, I mean, you can ask him, when we do reclasses, so like whenever I see a minister who had Social Security withheld, but they shouldn't have, when we do the corrections, I ask the minister and we often will reclass that as federal withholding.
I
So,
see.
and then you can either give it back to him or put it in the federal withholding.
Okay. Okay.
Either
All
option.
right. Thank you. This has been illuminating.
You're very welcome.
Thank
Any
you.
other questions? The proper way to document employer contributions to 403B. You know, the 403B question, document like in your file, in your documents, is that what you're asking, Brian?
we're going to get Brian, we get statements from Guidestone that would show that. I don't know if that's what you're asking. Can you,
No,
can you just,
I'm speaking to, whether or how they might be reported, say on a W-2.
Oh, employer contributions to 403Bs don't go on the W-2 at all.
Okay.
The only thing that goes on the W-2 would be an elective deferral from an employee, and that goes in box 12, code E for 403Bs. But the employer piece doesn't go on the W-2 at all and doesn't affect the W-2.
Okay.
So
Even if it's a matching.
Correct, even if
Okay.
it's a match.
So the Guidestone contributions are 403B, even though we may not have paperwork that says 403B. Is that correct?
I believe so.
it is
That's
a,
a more
yeah,
common question.
Okay.
it's a
Okay,
403.
good. Thank you.
Yeah.
Any other questions from anybody? All right, well, I hope this has been helpful. There's my
Yeah,
information.
Sandra.
Please
Thank you.
email me if you have questions. Oftentimes I can answer you back pretty quickly. It's no big deal. If it's something a little more complicated, we just have to get you set up as a client. It's not a big deal. But please let me know if you have any questions or anything as you go on. I would love to help y'all. This has really been fun for me, so I hope y'all have got something out of it. We'll talk to you later, I guess.
Thank you so much,
You,
Sandra.
Jim.
Yep. Bye-bye.
Bye. Thank y'all.